Did you know India, already the world's fastest growing major economy, could account for more than a third of the global oil demand by 2030? Now, behind that headline, there are three government-backed heavyweights. We've got Indian Oil, we've got BP, Bharat Petroleum, and Hindustan Petroleum, HP. Now, together, these three run 87% of our country's fuel retail network. That's dominance with a capital D. Welcome to Bottomline by Groww. Today, the plan is fairly simple. We'll break down how the oil industry is structured here, how oil marketing companies perform, that's OMCs, what's tripping them up, and where they might be headed to next. Now, before jumping into margins, multiples, mega projects, quick definition time. An OMC, an oil marketing company, sits in the downstream part of the oil value chain. Now, think of this chain as three clean slices. Upstream, you're finding and pumping the crude oil out of the ground. Think ONGC. Now, midstream, you're shipping those across oceans and into pipelines, GAIL India. Now, at the downstream, you're turning that crude into usable products and getting them into cars, kitchens, jets, factories, what have you. Now, that's where OMCs live. Now, India's three public OMCs, Indian Oil, BP, and HP, control most of that downstream action. Now, they import the crude, they refine it, and they move it through the pipelines and sell it at over 87,000 retail points, end-to-end, ground to nozzle. As downstream integrated players, these folks convert crude into petrol, diesel, LPG, petrochemicals, and they're selling it to everyone, from airlines to, local stores. When cracks are wide, they earn on refining. When pump prices are deregulated, they earn on marketing. And in between, they earn steady logistics fees. Think of it as multiple bites from the same apple. Now, in short, OMCs are that real vital link between global oil markets and us, India's 1.4 billion consumers. The bridge, the bottler, the cashier, all roll into one. Now, let's look at this incredible market they operate in. Now, India's energy scene is buzzing. We are said to be the world's largest driver of new oil demand right up to 2030. Now, we are talking roughly about 1 million barrels a day jump in consumption, taking that total demand to an estimated 7 million barrels a day by 2030. Big volumes, big implications. And this isn't just blue sky forecasting. India's petroleum product consumption already hit an all-time high of approximately 239 million tons in FY25. Demand is here, and it's growing. What's behind these demands? Long-term engines. Now, one, you have rapid urbanization that is set to lift city dwellers to roughly 600 million by 2036, up from 31% in 2011, turning every new locality into a fresh market for petrol and diesel. Two, mobility is also exploding. We have 185 two-wheelers and 34 cars for every 1,000 people. That's roughly 310 million vehicles and rising. That's a lot of tanks to fill. And three, aviation's on a parallel takeoff track. Domestic passenger traffic is set to double to 300 million by 2030. More planes in the air, more jet fuel burned. Simple. Now, to serve that surge, OMCs just aren't watching, they're also building. Our capacity. Now, India's refining capacity sits at 254 million tons per annum in 2024. That's MTPA. Keep that in mind. So now we have projects to push that 254 MTPA to 450 MTPA. That's a serious step up. We're talking major expansions. First, turbocharging refining and petchem capacity. The three OMCs collectively now control 60% of the country's 257 MMTPA refining system today. And they're doubling down on both brownfield debottlenecking and greenfield builds. Now, Indian Oil is planning to lift capacity from 80.75 to 98.4 million tetric tons per annum by 2028, including big upgrades at Panipat's to 25 and Gujarat's to 18 MMTPA. BP is also expanding its Bina refinery in Madhya Pradesh from 7.8 to 11 MMPTA as a part of the major ethylene cracker project, plus also exploring new refinery cum petrochemical complex in Andhra Pradesh. Hindustan Petroleum is scaling up its Visakhapatnam refinery to a total of 15 MMTPA. Now, in petrochemicals, it entered in 2022 with HP Durapol, and it's also working to expand their capacity. Next, let's talk about getting those molecules to market faster. Now, behind the scenes, pipelines are quietly booming. Over the past 5 years, OMCs added almost 8,000 kilometers to reach nearly 28,600 kilometers in FY25. That's a 38.6% jump. That's speed, scale, and lower costs. Now, the signal here is really clear. OMCs are scaling for today's petrol and diesel demand and positioning for a lower carbon transport future. Think flexible infrastructure for shifting fuel mixes. Now, let's talk about the market structure. Now, these three public OMCs control almost 90% of India's fuel retail market. That's pricing power plus economies of scale. And replicating this is really capital intensive. Now, Nayara is at about 6,500 outlets. Reliance's GeoBP is much smaller. So the moat that they have is very real. Now, the integration here also adds stability. Now, IOCs, pipelines, and petrochemicals help cushion refining cycles. It's an oligopoly, but it's one that operates under significant government oversight on consumer prices. And now, for the financial roller coaster. Now, Indian Oil had one of the sharpest swings. In FY23, their consolidated net profit fell to a little over 11,700 crore rupees, a 54% YOY drop, mainly due to heavy marketing losses. Then FY24 flipped that script. They had a record PAT of over 43,160 crore rupees. Refining margins surged, and that was helped by discounted Russian crude and recovering global demand. But that windfall didn't last. As refining margins normalized and the global backdrop steadied, FY25 profits cooled to almost 13,789 crore rupees. BPCL and HPCL echoed that pattern. Now, BPCL's net profit slid from 7,320 crore rupees in FY21 to 2,131 crore rupees in FY23, and then shot up to 26,859 crore rupees in FY24 before easing down to 13,337 crore rupees in FY25. Hindustan Petroleum, HP, dropped from 10,663 crore rupees in FY21 to 6,980 crore rupees in FY23, and then surged back up to 16,015 crores in FY24, and it normalized to 6,736 crore rupees in FY25. So, what caused this volatility? In FY23, crude surged to around $100 a barrel after the Russia-Ukraine conflict, and that pushed up import costs for a country that sourced 85% of its oil, us. Now, domestic petrol, diesel, and LPG prices were kept artificially low to shield us consumers. So, OMCs sold below cost, and they took huge marketing costs. Now, this is despite demand being really strong, mind you. Now, refining margins slipped from FY22 highs, piling onto that pressure. Now, under recoveries hit as much as 27 rupees 70 paise per litre on diesel and 17 rupees 40 paise per litre on petrol. And well, later, some developments did help eliminate those losses, but the damage was already done by this point of time. In FY24, that picture reversed. Now, global crude softened while retail prices stayed steady. Now, that gave the OMCs a healthy marketing margin for the rest of the year. Refining margins also rebounded on stronger product cracks and demand recovery. So, FY24 was a bumper year. Now, combined profits for IOC, BPCL and HPCL hit around 81,000 crore rupees for FY24, far above the pre-crisis annual earnings of 39,356 crore rupees. It's important we also talk about margins. Now, refining is central to OMC capability. Now, the global refining boom, especially around FY23, was exceptional at $17.28. Post-COVID demand plus discounted Russian crude juiced up refining margins, but frozen retail prices meant OMCs couldn't fully benefit from this. Now, you had marketing losses eating into those gains. And as things normalized, refining margins cooled to around $5.79 in FY25. Even at mid-cycle levels, FY25 brought something important back: pricing economy on petrol and diesel. That helped restore marketing margins and created that sweet spot. You've got lower refining margins, but healthy marketing margins. That's balancing the books. The result, robust operating cash flows. Now, Indian Oil generated 71,099 crore rupees in FY24, and that money was used to reduce debt and fund capex, laying down tracks for future growth. From an investor's lens, OMCs trade at moderate multiples. They're reflecting cyclical earnings and also the policy overhang. Here's a snapshot. Indian Oil is around 8.4x enterprise value to EBITDA and about 16.3x PE on FY25 earnings, helped by that profit surge. Bharat Petroleum, 10.2x PE on FY25, below its historical median of 12.9x. EV EBITDA at 6.3x, below the historical median of 7.5x. Hindustan Petroleum at 8.5x PE on FY25, around the historical median of 8.3x. EV EBITDA at 6.7x, below the median of 7.6x. Compared to the broader market, that's a steep discount. Now, for long-term investors, valuations look undemanding, but unlocking value needs consistent cash flows and less policy interference. On price action, while multiples are, still low, most of the recent share price pop came about in FY24, powered by that sharp earnings rebound. Cyclicality and policy are constant companions, but current valuations can still be compelling for the patient investor, especially with re-rating potential on the table. Meanwhile, OMCs aren't just saying sellers, they're morphing into integrated oil companies. First up, mega refinery expansions and petchem integration. Now, BPCL's Bina expansion in Madhya Pradesh plus a new ethylene cracker positions it as a serious petrochem player. The Indian Oil Corporation is expanding Panipat and evaluating a new coastal refinery with high petrochemical intensity. And Hindustan Petroleum's Barmer complex will boost refining capacity and add a large petrochemical portfolio. Higher value output, bigger margins over the cycle. With natural gas and renewables, all OMCs are in LNG import and city gas distribution. HPCL just operationalized a new LNG regas terminal in Gujarat. On renewables, Hindustan Petroleum has 224 megawatts, Indian Oil has 252 megawatts, and BP has 155 megawatts of capacity. Small but growing building blocks. With biofuels, they're spearheading ethanol blending, already around 18% and tracking for 20% by 2025-26. BPCL's Bargarh biorefinery is a part of the push, and green hydrogen pilots are underway at refineries. And now, let's talk risks. First, regulatory intervention. Even with the deregulation, prices can be informally guided to control inflation. You remember 2022, a few years back? Pump prices were essentially frozen for 8 months while crude spiked and OMCs swallowed those heavy marketing losses. Support came in later, but timing is everything for quarterly earnings and sentiment. If oil surges again, price caps could return, turning OMCs into piggy banks for public policy at the expense of minority shareholders. Now, windfall taxes, which were imposed in July 22 and now disregarded, can also skim refining upsides when margins are hot. Second, commodity cyclicality and margin volatility. Now, refining is a cycle-heavy business. After the FY23 boom, margins are back to mid-cycle and a global oversupply phase is possible as new capacity ramps. Now, every dollar per barrel move in GRM hits EBITDA very meaningfully. Third, Russian crude dependency in FY26. Now, discounted Russian barrels account for up to 30 to 38% of intake, and that's boosting GRMs by $1 to $1.5 per barrel. Any disruption, geopolitics, tariffs, sanctions, means switching to pricier crude from the Middle East, US or Africa, means adding $3 to $3.5 billion annually to the import costs and throwing off product yields. Plus, a weaker rupee can inflate costs. You see, crude is bought in USD and revenues are in INR. Now, this is raising the risk of inventory and FX losses to dollar debt. And lastly, we have energy transition. Now, oil demand is likely to grow in this decade, but could peak in the 2030s as EVs, efficiencies, and alternate fuels chip away, while carbon pricing pressures long-term margins. So, where do the OMCs go from here? The big forces: policy, crude cycles, Russian discounts, and the transition will shape earnings and valuations. Now, the build-out in refinery, petchem, gas, biofuels, and renewables is their hedge and their shot at re-rating. So, what do you think? Drop your thoughts in the comments below, and thanks for watching Bottomline by Groww.